one question we get sometimes is, $7,000 doesn't seem like that big of a deal. And so I thought it may be good to walk through an illustration of how that can play out over time. So the example I want to paint is a 30-year-old couple that's kind of in the position where they've started to make good money and they're looking for additional ways to save. They say, we're going to fund our Roth IRA. So husband and wife both fully fund $7,000 into a Roth IRA, $14,000 total. And they do that every year until 65. So what does that look like over time? If we assume an 8% rate of return on that money, by the time they turn 65, it will have grown to $2.4 million. That's totally tax-free at that point in time. Now, of that, $1.9 million is growth. So a pretty significant portion of the overall account value at that point in time is growth. Now, the alternative would have been they save and invest that money in a taxable investment account where they would have been subject to capital gains rates. Most people that we work with right now, they're in the 18.8% long-term capital gains rate when you factor in the net investment income tax. So that would be a tax bill of $357,000 if they were to sell that investment and pay the long-term capital gains and the net investment income tax.